Hello and welcome to chapter 27 of the course. And we're going to continue our learning with the book, The Great CEO Within. Okay, so this is going to be about raising funds for the business. So it says first that you pick a partner and not a firm. And in one of the early chapters, especially in part one, he talked about partnership and why it's important to have a partner. That having one partner is better than having no partners at all. And having two partners is also good because in terms of voting, you can have two-third majority, literally two-third majority if you are three co-founders in the business. So pick a partner, not a firm. When you raise money, you also get an investor. I see why it says pick a partner, not a firm now, because you have venture capitals these days who are investing into businesses. It's a common thing across the world. So the point is making is about finding a partner, even in your investor, whether it's a venture capital, they have to be interested beyond just giving money. I think that's it. But let's go into it. When you raise money, you also get an investor. Make sure you get the partner that you believe will add value and be good to work with. Don't allow the choice of partner to be made by the firm, that is the venture capital, or any other firm who is investing into the business. Find out from other founders who at each firm is a good person to work with. Make sure they're going to be with the firm for the long term. That is the person who is going to be a partner with you. And I remember in the early chapter when he talked about partnership, it said something to the effect that a partner doesn't have to be with you for eternity in the business. They can be with you for time. They could come in at the early stage of the business and then help you grow the business into a certain point. They could be there for 5 years or for 10 years. That the quality, I think the quality of that relationship and the quality of that partnership matters over the length of time that the partner is with you. So he says that here now that a long-term partner is even better. If you have a partner who is great and they're in with you for the long term, then that is a better thing. But if, one of the things about small CEOs these days is that they are afraid to have second persons in the business, and that isn't very helpful. I've noticed this in my own personal experience. I've noticed this thing around software engineers. They are not so open, especially software engineers who are really at the lower rung of the ladder. They are not very open to having partners who aren't of the same software engineering background as they are. And that's not effective. At least I've heard that sentiment from two software engineers, and they are really just growing software engineers, but they are averse, even when the other partner is knowledgeably experienced and has some funding to invest in the business and can take the business forward. They have said that they do not want to partner with somebody who doesn't understand their work in engineering. And by understand their work in engineering, they are leading to the fact that the person who talked to them about partnership doesn't have an engineering background. And I think that's bad. That's not the kind of partnership approach to partnership that he's talking about here. Long-term partnership doesn't necessarily mean that a great partner is going to be somebody who is in the same line of work as you are. They just need to be invested in the company for the long term and invested enough, even when they are in it for a short term, they're helping you get past or helping you get to a point of growth. Sometimes you might have a partnership comes in the early days of the business, and the thing that they help you achieve is getting to $1 million ARR. I think that's also a good thing in terms of that kind of partnership. Introductions. The introduction is a key part of the fundraising process, and you only get one chance to use it. I recommend using the triangulation method. the triangulation method for introductions. Let's read about the triangulation method. When you want to be introduced to an investor, find 3 to 5 people in your network who know that person. Then ask each to send an email to the target investor, letting her know how great they think you are and highly recommending that she meet with you. After receiving several such emails, the investor will proactively reach out to you. She has received recommendations before, but never 3 or more for the same person. She concludes that you and your company must be truly great. So she already is inclined to invest in you before she even meets you. So that is the explanation of the triangulation method. So you're basically using 3 or 5 relationships that you have, mutual relationships that you have with the investor, and you're using that relationship to wet the ground or to prepare uh, your meeting, your introduction with the investor. I think that's a very good way to lessen the burden to have to impress, because you already have people who have done a good work recommending you and telling them just how good you or the business are, you and the business are. So for your side, stack all the referrals in a short period of time within a week, just with just as with PR chapter 27. We're looking at that in the next chapter. I've noticed that sometimes when he refers to a subsequent chapter, that chapter is not exactly at that particular place. Sometimes because of the updates they would have made to the material since the initial writing, the chapter has adjusted forward or maybe backward. So but in case we don't see PR in chapter 27, we're still going to see PR. So just as with PR, chapter 27, you are trying to achieve critical mass and have the referrals rise above the noise of other referrals. Stacking the referrals close together ensures that they rise above the noise. It's important to hand each referrer the same potential text to send onward. If they end up sending the same language, then the referrals are revealed to be orchestrated by you. It says it is important not to hand each referral. So that's a good point. Not to hand, so it doesn't look orchestrated. It has to be organic. So just ask the 3 to 5 to make the recommendation. So sometimes the EA might be asked to draft this text that will be sent to each of the 5 people. So you have to understand why it's important for you to draft a very good text like that may be used. You might eventually give it to your CEO, and your CEO shares it with their contacts, and their contacts make edits, or they personalize it to their taste. But the point is, if you're working with the CEO at this level who's looking for a partner in an investment firm, then you have to understand the relationship and why it's important. Therefore, either give your referrals different suggested language or no suggestion at all. I think no suggestion is good, but if you have busy friends, then you want to give suggestions. Then there is another method, it's called 2 methods. There are 2 ways to raise money: the traditional method and the relationship method. The traditional method is when you pitch an investment firm with your story, most often with a slide deck. That describes the customer problem, your solution market size, unit economics, financial projections, competition, team members, traction, go-to-market strategy, and so on. You might run through your presentation dozens of times before you find a spark of interest in they might run through you might run through your presentation dozens of times before you find a spark of interest in either you or your company. I think this one should be they might run through before they find a spark in you or your company. Okay. Then the relationship method is to build a trusting, friendly relationship with an investor before ever discussing what your company does. This takes more time, but it dramatically increases the close rate because now they are your friend. and they would already be interested in seeing you succeed personally. So by the time you're talking to them about a business that you've built and you're looking to raise money, they are one already interested in your success personally. So the business is an opportunity to further invest in your success personally, but even more for them to make money, especially if they are also really looking towards building another firm. Investors are always on the hunt for great ideas, great operators, and for great companies. So if you have a relationship with one, that increases the close rate, he says. So the close rate is just a way to describe whether or not they will decide to invest with you. This works because no matter how rational we appear, we are most often guided by our emotional responses. We make instinctive gut choices, and our rational brains do an excellent job of retrofitting logic over those choices. So we underline this or we highlight this one as well. That's the relationship method. Then it says the first time you talk about your company, the investor will make a decision about whether or not she wants to invest. If she does not like or trust you, then your investor had better be optically perfect. And optically perfect, that is, if they don't like you, then they might find something that they like about the presentation or the company. And more often than not, it isn't. That is to say, if they don't like you, the chances that they'll find something interesting about your company to like is very rare. So I think the relationship method, using the triangulation method, on which the triangulation method is a subset, I would say, of the relationship method. So I think you have to be high on the relationship as well, but also do an excellent work of making a good case for investing in you or in your business. So the key is to wait to talk about your company until you are sure that the investor likes and trusts you personally. By then, the investor will have positive bias toward you and will be inclined to invest in your company, what's and all. But how do you get the investor to like and trust you? That's what we're going to look at in the next chapter. It says build trust and like. Think about the people you like. Do you like people who just talk about themselves and show no interest or curiosity about you and your life? Or do you like people who ask about you, listen attentively, and are genuinely curious about what makes you tick? When meeting potential investors for the first time, ask them about themselves. Get genuinely curious about their lives, both at work and at home. Ask them a lot of questions. Prove to them you're listening by saying, I think I heard you say, and then repeating back to them the highlights of what they said to you. Then the meeting ends. When the meeting ends, write down as much information about the person as you remember. That's where you're stacking important information about this person that you would refer to or use as context as you continue to build that relationship. At your next meeting with them, say something like, the last time we talked, you said, and again, repeat the highlights. It is heartwarming when we find someone who cares enough about the details of our lives to remember them. Also, let them know what they have done that you appreciate. If nothing else, you can always appreciate the fact that they took the time to meet with you. But how do you get a meeting in the first place without the explicit purpose of talking about your company? You can use the triangulation method outlined above, but if you don't have enough mutual acquaintances, you can simply ask for it. Be explicit about your intent to build a relationship. Say something like, we only want to work with investors with whom we have a good relationship. So let's start with a coffee to get to know each other personally. So that is something good. Let's highlight this part because it contains a good dose um, of information. So After the first meeting, ask for a second. Since the stated purpose is to build a relationship, the investor is likely to say yes. If you have truly allowed them to speak about themselves, they will have enjoyed the meeting and will look forward to another. These meetings do not need to be long, nor do they need to be in person. A 15-minute phone call can be as effective as a 1 hour meal if, after time has passed, you demonstrate genuine care and the memory for the details of their life. After the first meeting, you show that care and attention to them. Then, after the second meeting, after 2 meetings like this, when you listen to them and reflect back what they say, they will trust and like you. What's important is reflection. You listen attentively and then you get important details and then you show that you care about the things that they've said. Maybe they express the pain point, maybe they express something that they like, so you might want to check it out and learn more about it. And in subsequent meetings you continue to show that reflection. I think that's a genuine natural way to build relationship, because usually when we're building relationship with people we don't know, we build a relationship because there's something that they said or that they have or that they do that we like. So it's important to capitalize on that, on reflecting that thing that you admire about the person. So several more, and they will love you. You'll know when the moment comes that they like and trust you. They will likely say it. If not, their body language will show it. You then proceed to talk about your company with the confidence that they are already inclined to invest. I think this part is very important. You proceed to talk about your company with confidence, because if after the hard work of building the relationship you aren't speaking with confidence, then there's just going to be a good problem there. You might have them say, you know what, I like you, but I don't think I want to invest in your business right now. So they like you as a person because you've shown interest, you've invested in that relationship. So you've shown interest in them and all that. But because you maybe did not speak about your business confidently, you didn't know your material well, you didn't know the industry well, then they might turn it down eventually. So building a great relationship with them does not guarantee that you're going to get to close that opportunity, but it sort of increases your chances of feeling comfortable enough to talk about the business and then do the ask. You have to be comfortable enough to ask for the money at the end of the day. If you aren't good at reading body language, just wait. At some point, they will say something like, and this is an actual quote from an investor: I really like you. I want to invest in you. Now, tell me what your company does. To summarize, the 4 keys are: ask them about their lives, prove that you heard by saying, I think I heard you say, prove that you remember by saying at the next meeting, the last time we talked, you said, let them know what you appreciate about them. Okay. If you do all 4 of these things, you will have created a bond and you then have a willing investor. When most CEOs hear of this method for the first time, they have a strong negative reaction. This method feels unnatural and goes against their instinct to close quickly. Yeah, the second method is, so usually if you want to close quickly, then just do the first method and send over a pitch deck or go through the investors online form. Then you upload your pitch deck, send a video or whatever else you can send to close quickly. But if you're not keen on closing quickly, then the relationship method is really important. And he's saying here that people really don't like the relationship method because of their instinct to close quickly. Someone maybe have been building business for a very long time and then they get into a point where they absolutely need the money to continue the business, and maybe it might be tied to their livelihood. So I can understand why someone might be really interested and have a deep need to close the business quickly. But then it says later, once they have tried that method or the method and it works like a charm, they become raving fans. My best advice, therefore, is to try on a few prospective investors and see if it is more effective than the traditional method. The traditional method being just sending over a slide deck or applying through a formal means. Then he goes on to talk about strengthening the relationship. Once you have met with someone a couple of times and demonstrated your memory and care for their lives, you have created a relationship. This is likely enough for them to like you. But why settle for just enough? To further strengthen the relationship, continue to be curious about them and show them that you remember what they say. 3 to 5 rounds of contact will solidify the relationship. Not every round of contact needs to be an in-person meeting. It can be enough to send a quick message. Here is an example of a mass message of appreciation which comes from a managing partner at one of the most successful investment firms in the world. Hey Matt, just wanted to drop a note of thanks. I really enjoyed our talk on Tuesday and brief ones since. Also, greatly appreciate you treating me to lunch. Talk soon. Bill. I feel honored that he took the time to appreciate me, he says. The following comes from Andy Bromberg, founding CEO of CoinList, who takes it a step further. At the risk of giving up my secrets, I'd suggest handwritten thank you notes. The response I get to my handwritten notes is incredible. People are flawed and often remember me as the handwritten note guy. So make it a practice regularly to go through your contact list and send out messages of appreciation. You'll be shocked by the massive goodwill that it generates. And this suggests making this a formal process. He says, every day I review all my interactions and send or schedule thank yous as appropriate. It ensures I don't miss anyone and I'm prompt. And it takes literally a few minutes. Next, it says, sell yourself, not the company, not your company. Cliff Weitzman, CEO of Speechify, realized that it was key to sell himself and not his company. If he was able to do so, he would gain investors for life. Yeah, if you sell yourself and not the company, you get investors for life. If you sell the company, you get investors for the period of the company or as long as the company succeeds. But if you sell yourself and the personality that you have and they like you, they bond with you, then you have friendships that become much more than just the informal relationships that they are. They also carry a significant weight. They might become spiritual partners with you. They might become life partners and so on and so forth. So it says, if he was able to do so, he would gain investors for life, investors who would follow him through every pivot and every company. So when Cliff realized that trust and like had been established, he shared the story of his life using a method that his brother Tyler had discovered. Tyler Weitzman, CEO of Black SMS. Oh, you see, you have one brother who is the CEO of one company, and then you have another brother who is the CEO of another company. I like that. I like that. Uh, Tyler Wertzmein, CEO of Black SMS, likes to research social institutions. As an undergrad at Stanford, he researched a method for conveying one's achievements, or bragging if you prefer, while remaining humble and relatable. Through countless interviews of master storytellers, Tyler determined the ultimate structure for telling one story in a humble way. Credit. So you start by giving credit. Yeah, it could not have happened without the name of others involved. So you start by giving credit. Then you talk about the hard work that you did. We had to put in so much to make it happen. For example, describe the hard work. Vulnerability. Then you describe vulnerability, the fears and concerns that you had or that you suffered. It was most difficult for me when then the duty that you exercised, we were driven by our dream to noble motive. Then gratitude. I am so proud and thankful for that. You close by gratitude too. You start by gratitude, which he calls here credit. Okay, it could not have happened without this person. All the people involved, you want to show that you appreciate them, so that the focus then isn't on you. So there are CEOs who like to see people confident enough to talk about what they have done, but then there are other um, investors who just like to see that you understand you are one person within a team and that you are not thinking of yourself as an indispensable material, especially in the early days when you do not have funding. I encourage you to tell your story. Let us highlight this one. It says, I encourage you to tell your story using this method. I encourage you to tell your story to a friend using this exact structure. See what comes out. Ask your friend for a reaction. I think you'll be amazed. For example, an example of this method, see the acknowledgement section at the end of this book. Timing. Timing is also important. There are milestones in a startup's life that, once achieved, make it significantly more likely that the company will eventually succeed. Each of these milestones or inflection points greatly reduces the company's risk and makes it much easier to raise money. Your company's value then does not rise in a linear fashion, but in a stair-step pattern, as indicated in the chart. Stair-step pattern. This is roughly the J curve too. Is it J curve? The J curve is like this. Maybe it's not the Jacob, but there it goes by other names. Essentially, you have it growing, not necessarily steadily, but there is some progress. But then it follows an astronomical rate, essentially. Examples of inflection points include hiring a capable engineering team. Inflection point simply means points where you can sense historically that things changed, like the needle moved forward after you did something or something happened. So hiring a capable engineering team, signing up your first 3 paying customers exceeding $1 million ARR, which demonstrates product market fit, hiring a capable sales team exceeding $5 million ARR, which demonstrates the effectiveness of your sales team, hiring senior managers for all departments. The best time to raise money is just after you've hit an inflection point. This is because your company has just increased in value, but will not increase further until it hits the next milestone, which could be months away. So best time to raise money is after you hit an inflection point. And then he has given these examples of inflection points, notable inflection points to consider. So let us highlight these notable ones. Simple agreements for future equity. Simple agreements for future equity, SAFEs versus priced equity. Is safe. I've heard this term used in Shark Tank, but I have not really got a hang of this. By the way, let me just talk about Shark Tank for a moment. Shark Tank is the video that has really exposed me to business, especially the way business is done in more developed economies. The credit will be to Shark Tank for that one. So this is Shark Tank. I love it. I think most people by now already know Shark Tank, but if you're a virtual executive assistant and you've not watched Shark Tank or been following Shark Tank, then just whatever you're doing that has made you not get to a point of watching Shark Tank, reverse it. Immediately reverse it. You have to watch at least one season of this show to understand the struggle that it takes for people to build businesses, because you're essentially working for someone who has built a business or is trying to build one. So you have to see people, although it's usually like 7 minutes for each person, while they've had like years of building the company and all that, of excellent work, hard work, and so on. So it's not enough for each one, but if you watch a season, it gives you a good sense of what's going on. And I've been watching, I think I've watched as far back as season this is season 17. I think I've watched as far back as season 12. And I used to have so many downloads of the show because I was really following it to learn and understand how business is done. And it was one of the things that made me began to begin to take business seriously and to think about what I could do in the business space and not just in the public sector space. And I'm grateful for the things that I've learned through Shark Tank, and I want to do a lot more. learning, and one of the best ways to do so is to just work with a CEO, whether they're Shark Tank CEO or not. The point is to say you want to work with somebody who, and I've had two CEOs who were in the startup phase, that is in the early phase of the business, and there was so much you get to learn. You enjoy the relationship as well. But if you get to work with a CEO who's relatively successful, it's also a blessing because you get to learn a lot about the things that they did to where they are. So it's safe, and its cousin, the convertible note, I don't know much terms well, are investments that are used when it is impractical to create a priced equity round, either because the amount raised is too small, or you do not have a institutional investor to lead the round. Priced equity rounds usually incur large legal costs, often over $100,000, which the company invariably ends up paying for. Safes and notes are much less expensive, with legal fees often less than $10,000. You should therefore only do a priced equity round if the total money raised will exceed $2 million and preferably exceeds $5 million. So if it's going to be less than $2 million, then you should be looking at safes. Then if it's more than $2 million, you're looking at price equity. And what did he say safes are? Safes are investment notes used, are investments that are used when it is impractical to create a priced equity round, either because the amount raised is too small or you do not have an institutional investor to lead the round. So that's also because of the legal fees involved. Saves rather, um, saves rather, this is where we are. Saves are usually Safes usually convert at a discount to the next priced round and can also have a valuation cap. I recommend always having a safe open even after you do a priced round. Here is an example of what this might look like. When you start a company, you would raise your initial money of $2 to $5 million in a safe. When you hit product market fit, you raise an additional $2 to $10 million in a Series A price round, and the safe converts into this round. You then immediately make available another safe, continue to leave it available on until you have raised another $5 to $10 million. Once you hit $5 million in ARR, you raise a Series B price round of an additional $5 to $20 million, and the second safe converts into this round. You then make available a third safe round, and so on. So I don't know much about safe still, but let me just Google safe to sort of, because that explanation isn't very clear for a dummy like me. A simple agreement for future equity is a contractual investment instrument and used primarily by startups to raise capital without determining a company's valuation immediately. Great. Developed by Y Combinator in 2013, it acts as a often founder-friendly alternative to convertible notes, allowing investors to receive future equity during a usually subsequent price round. So the safe is done at the earliest level before the price rounds, and the reason the safe is key is because you do not have the company's valuation determined immediately. And this, I think I get why this safe is important, because by the time you have the early investors valuating the company, it it could potentially hinder, especially if you are not immediately successful, hinder the chances that you get other investors because of the rates that the early in valuation rates that the early investors made. So that's why it's just nice to use the safe method in the early stage of fundraising, and then when you get to like $5 million ARR, as he said, you can then look into price round or product market fit. You can then start looking at price round in Series A or Series B. Institutional investors prefer to invest in priced equity round. Institutional investors prefer priced equity rounds, but family offices and Even strategic investors who are not accustomed to leading price rounds are often very willing to participate in saves, even as the company matures, as long as they have confidence that there will be another priced equity round. Therefore, there is little downside in always raising the first tranche of a round in a safe. This money extends your runway to reach the metrics required to raise the next priced equity round. So this is a key part here. Price rounds by Alex McCall. At some point, you will need to convert your saves and do a proper price round. This usually happens at the Series A, but can sometimes happen at the seed. Let's talk about seed stage. What is the seed stage? Seed stage of business. So seed capital, the seed stage is the initial phase of a startup, moving from a raw concept to a functional testable business. Okay, that's the early stage. Okay, it focuses on validating the business idea, developing a minimum viable product. So seed stage is something as the MVP stage. Finding product market fit. Product market fit is higher than MVP stage. I would say, because product market fit, according to Matt Mochary, the product market fit stage, when you're eating product market fit stage, that's 1 million ARR. That's a rough sales of $100,000 every month. So it's not exactly the same level as an MVP. Like the MVP, I would say is a little earlier than the product market fit, but it says it focuses on validating business idea, developing a minimum viable product, finding product market fit, and securing initial capital to prove feasibility, typically with small scale testing and early user feedback. Okay, so return here where it says this usually happens at the Series A. So price round usually happens at the Series A, but can sometimes happen at the seed, which is much earlier, like when you're looking at the MVP or the ARR stage. Since this involves a lot of custom terms and negotiation, it can be an expensive process both in terms of time and cash. What often happens is that founders receive a bunch of term sheets with artificial timelines. Then they rush through the process and end up signing terms without understanding the long term ramifications. It is incredibly important to take your time and not make any mistakes here. They will come back to haunt you. Treat this process as irreversible. Take your time to go through every clause in the term sheet with your lawyers to fully understand them. Investors have a huge informational advantage over you. They sign these term sheets all the time. They are experts at controlling companies as minority stakeholders, as minority shareholders. Often the tools they use are hidden in this special provisions set of clauses. While you may think these provisions innocuous, innocuous at the time, they can be activated out of left field when you least expect it. When you like when you're selling your company. So like when you're selling the company, you might sell a company, your CEO might sell a company and still be unhappy because the investors got the better share of the money. So if you work for a CEO who knows that they're going to lose a lot of money or lose the company, like lose a lot when they sell, then the CEO is most likely to come back into the game after they sell, like through another company, of course. Don't rely on your lawyers to highlight the dodgy terms when they may consider what they may consider standard, you may not. Pass your term sheets scrubbed if necessary by other founders and investors you trust for feedback. If you do discover unethical terms, blacklist that investor. If you discover unethical terms, blacklist that investor. Legal expenses. Looking for money is expensive. You will need a named brand law firm to manage your price rounds. Haha. In the early stage, you might not need a a a, a law firm. of that status, but it says you will need one when you're going for price rounds. They will only be too eager to help. This is one of their this is one of their favorite ways to bill large amounts. But there is a technique to manage costs and time. If you let them bill however they want, the end result could easily be over $100,000 for a Series A investment. If you manage them aggressively, however, you can get that bill down to $15,000, really, or less. This is important because the company is often required to pay for both their own counsel as well as that of the investor if the bill exceeds a certain amount, usually $25,000. So if you are the owner of the company, you get to pay these are if it exceeds $25,000. So you also want to be careful about how you manage your your legal services during Series A investment. So this is a really technical field. I do not yet relate with this because I do not have much experience with it. But reading it, I'm referencing in my memory the episodes in Shark Tank that I watched where they talk about money, fundraising. So a typical investor happens like this. Lawyers call each other to discuss the terms. They disagree on a point. Company lawyers calls company decision maker for guidance. For every email written or voicemail left, the lawyer charges for 15 minutes minimum, but usually 1 hour. Company decision maker responds to company lawyer, another billable hour. Company lawyer reaches out to investor lawyer, another billable 1 or 2 hours. Investor lawyer then reaches out to investor decision maker on this same issue, another billable 1 or 2 hours. Investor lawyer responds to decision maker lawyer, another 1 or 2 billable hours. This continues back and forth, racking up billable hours until every detail is agreed upon. The process takes 45 to 60 days to get final documents, and the legal bill is often over $100,000 for each side. Wow. But I mean, it's interesting looking at this from an hourly rate basis. In most Nigerian companies, mergers and acquisition talks are part of the salary. The salary, like you don't get billable hours. You just talk for as long as is necessary. But I think that's changing. Some companies now give their managers and M&A lawyers percentages, something like commissions on the closed deals that they have, I think. But there is another way. It results in final documents in less than 1 week and legal bills of less than $15,000 from each side. Investors must pay for legal bills out of their management fee income. This income would otherwise go into their individual pockets. So investors do not like to pay for legal fees, even their own. They would much prefer to give the company more money which comes out of the fund's investment capital, and have the company pay for the investors' lawyers. Make this accommodation for investors require only that the investor support you in enforcing rules of behavior on their lawyers, and those rules of behavior on their lawyers. Once the basic terms of investment are agreed upon in a term sheet, then a 4 to 8 hour meeting or call is scheduled. This meeting may only last 2 to 3 hours, but it is very important that enough time be blocked off to allow it to run longer if necessary. Required attendees are decision maker from the company, decision maker from the lead investor, lawyer for the company, lawyer for the lead investor. If any of these four people cannot make the meeting or call, then the meeting is rescheduled. The point is you want to ask your investor to have a cordial relationship with you through this process and not just like cast all the billable hours onto you, because that also reduces the amount of money you spend trying to get the investment, and eventually the amount of money you have left after settling all the legal fees once you get the investment. The lawyer for one side prepares the first draft of the investment document. Remember, this is still part of the conversation around the typical investment, what the typical investment opportunity looks like. Investment calls and conversations look like. The lawyer for the other side responds with written comments prior to the meeting and call. There is no other contact between the lawyers. At the meeting, everyone reviews the documents from the beginning to the end, paragraph by paragraph, and addresses all of the written comments. Lawyers are not allowed to speak except to advise their client on the meaning of the paragraph being reviewed. The negotiation is between decision makers at the company, the CEO, and the lead investor directly. The decision makers go through every point until they have reached agreement on all of them. As each point is agreed upon, the lawyers then, in real time, agree upon the wording that best reflects the business agreements that was just made. So I think I'm going to skip all these parts because it's mostly about the CEO's work. But the reason it's important for virtual assistants or for executive assistants is at least you know what's going on. You have an idea of all the conversations, because sometimes you will be the one managing the email of the CEO, and then you flag important emails that you need to respond to. So if you're managing the email box and you do not know how to tell how important the email from an investor is or from a lawyer is, then it might affect your performance as an EA or EVA. So you need to have an idea of this. That's why I'm reading this book anyway. It's not like it's a book for virtual assistants. From the beginning, we know it's a book for CEOs, but we're reading this because you absolutely cannot be a very resourceful or very good virtual assistant if you do not have an idea of the CEO's life and what it takes to run the company to get investment. You don't need to be on the same level of knowledge. That's never really the case. Sometimes it can be the case that the chief of staff is somebody who is way more experienced and knows more than the CEO. Okay, that has happened. I've seen that in some cases, especially where the chief of staff is somebody who has been in a similar position, and for some reason they lost it, and then they are now guiding or helping the younger CEO through this stage. The point of the matter is, if you're younger, especially these days as virtual assistants, you're usually a far less experienced person. You want to have an idea of the CEO's work and operations. So that's why it's important to have an idea of what's going on with all these funding terminologies. That's why I'm reading them anyway, so I have an idea. I usually like to approach things that I have an idea about, because it prepares me for for learning, and just knowing how much of learning is going to be involved before I eventually get a knack of the task or the job that's to be done. Mark Zuckerberg retains voting shares. Mark Zuckerberg retains total control of Facebook, even though he only owns a minority of its shares. Why? Because the shares he owns come with extra votes. Now, now that this structure has been accepted by investors, there is little reason not to set it up in your own company. And the easiest time to do this is prior to having equity investors. Ask your lawyers to set up founders shares, founder shares prior to investors being on the cap table. Safes are fine. So founder friendly shares. In addition, founder friendly shares allow founders to get liquidity at each price round without raising the fair market valuation of the options granted to other team members. This allows founders to continue to pay themselves low salaries, excellent optics within the company, but still get enough liquidity not to worry about committing themselves to the company for the long term. Again, these should be created prior to having equity investors. Carter, formerly e-shares. Managing stock certificates is painful for both investors and company. Avoid the hassle by using an electronic system like Carter. So this is an electronic system, or even just a simple spreadsheet from day one. It costs far less than paying your law firm's paralegal $300 per hour to answer every question your investors have about their ownership. Carter provides instant access to that information for your investors who likely already have most of their portfolio on Carter, and their tax 409 valuation service costs about a quarter of what other independent 409A services charge. I've heard this term 409A. I need to look at it. It's usually something around selling a company or raising funds too. So you will need to do evaluation of your common stock to determine the correct exercise price for any options that you issue. This is a 409 IRS code valuation and must be done prior to issuing options. This is around stock market. Option pool. When raising for a priced equity round, know that investors will want to see enough unissued options, option pool remaining, that there will be a 10 to 20% unallocated option pool after the equity investment. This fact often catches founders by surprise. It's wow, required by law. So there has to be something back. So imagine you gave out 50% of the company and you thought you were going to have 50%. Is saying here that 10 to 20% unallocated pool after priced equity round. Okay, let me continue reading to understand better. When the venture firm offers $4 million on a post-money valuation of $20 million, the founders think that they have been diluted by 20%. But this same offer will almost always require a large option pool be created prior to the equity coming in. This post-money option pool plus the new equity therefore represents 40% dilution to the existing shareholders. This isn't much that you can, there isn't much that you can do about this. Just be aware of it. Okay, just be aware you need to have like a pool of 10 to 20%. So, recruiting, that's chapter 28. We've come to the end of chapter 27. What were we doing in chapter 27? We've been looking at fundraising, but before we got to the point of looking at fundraising, what we were talking about is just business process from the previous video, business process. And we said there are three important broad stakeholders that you're managing. Remember, it says process. Peter Reinhardt of Segments correctly points out it is also a process of aligning a huge number of complex stakeholders to accomplish something together. And who are the three complex stakeholders? You have the investor, you have the employees, and then you have the customers. These are the three complex relationships. And now we've just looked at in this video, chapter 27, we've just looked at managing investors. And so in the next video, we're going to look at managing the team. That's what recruitment is going to be about in chapter 28. And then in chapter 29, I think we'll look at customers. So thanks for watching. See you in the next video. God bless.